Look at this map of Rome at its peak, and then look at China today. Two superpowers separated by 2,000 years. But here's what's wild. They're showing the exact same economic warning signs. And I'm not talking about conspiracy theories or doom scrolling. I'm talking about real, measurable economic indicators that historians and economists have identified as the precursors to imperial collapse. So in this video, we're going to break down the specific economic patterns that brought Rome to its knees, and then we're going to examine whether China is following the same path. Because understanding these warning signs isn't just about history. It's about understanding the future of global economics, geopolitics, and your own financial security. Let me start with Rome. And I want you to really think about this, because it's the foundation for everything we're about to discuss. Rome didn't collapse overnight. It didn't fall in a day or even a decade. Instead, it experienced a slow, grinding economic decline that took centuries to fully play out. The empire peaked around 117 AD under Trajan. At that point, Rome controlled roughly 5.5 million square kilometers of territory. It had the most advanced military on Earth. Its infrastructure was unmatched. Its currency was trusted across 3 continents. But then something shifted, and the shift started with economics. Here's the first warning sign: runaway debt. By the 3rd century AD, Rome was spending far more than it was bringing in. The empire was maintaining massive armies, building infrastructure, paying bureaucrats, and managing vast territories, but the tax base wasn't growing fast enough to cover these expenses. So what did Rome do? It did what desperate governments have done throughout history. It started devaluing its currency. The denarius, which was originally made of 95% silver, gradually became diluted. By the time of Emperor Caracalla, around 215 AD, it was down to 50% silver. By the time of Emperor Gallienus in the 260s, it was barely 5% silver. This wasn't some secret economic strategy. Ordinary people noticed. Prices skyrocketed. Inflation hit double digits, and trust in the currency collapsed. Now think about what happened next. When people lose faith in the currency, they stop using it for long-term transactions. They hoard goods instead. They barter. They move their wealth into land or precious metals. And that's exactly what happened in Rome. Economic activity contracted, trade slowed down, tax revenues fell even further, and the government responded by devaluing the currency even more. It was a death spiral, and it took the entire economic system with it. Here's something that really drives this home. Historians have documented that by the end of the 3rd century, prices in Rome had increased by roughly 300% compared to the beginning of the century. That's not just inflation, that's hyperinflation. And it happened because the government kept printing more and more debased currency to pay its bills. Sound familiar? This is exactly what happened in Zimbabwe in the 2000s. The government printed money to pay its debts, prices exploded, the currency became worthless, and the entire economy collapsed. It's the same pattern repeating across different centuries and different continents. The second warning sign was declining productivity. Rome's economy was based on agriculture, trade, and military conquest. But by the 3rd century, agricultural productivity was falling. Why? Because the empire was spending so much on military defense that it couldn't invest in infrastructure improvements. Roads weren't being maintained, aqueducts were crumbling, irrigation systems were failing. And without those systems, farmers couldn't produce as much food. So food prices went up. People had less money to spend on other goods. Demand for manufactured goods fell, and the entire economy contracted further. But here's where it gets interesting. Rome also faced a serious problem with urban decline. The great cities of the empire, which had been centers of trade and culture, started shrinking. Archaeological evidence shows that cities like Rome itself, Alexandria, and Antioch lost significant population during the 3rd and 4th centuries. By some estimates, Rome's population dropped from over 1 million people in the 2nd century to around 300,000 by the 6th century. That's a 70% decline. Why did people leave the cities? Because economic opportunities dried up. When trade collapses and manufacturing declines, There's no reason to live in a city. So people moved back to the countryside. They became subsistence farmers. They retreated from the monetary economy into a barter-based system. And as cities emptied out, the tax base shrank even further. It was another vicious cycle. The fourth warning sign was rising inequality. As the economy contracted, the gap between the wealthy and the poor actually grew wider. The wealthy had land, precious metals, and connections to the military or government. They could survive economic collapse. The poor had nothing but their labor. And as the economy shrank, there was less demand for labor. So the poor got poorer, while the rich got relatively richer. This created social instability. People lost faith in the system. They stopped supporting the government. And they became vulnerable to alternative ideologies, including Christianity, which promised a different kind of social order. So those are the four main economic warning signs that preceded Rome's collapse: runaway debt, declining productivity, urban decline, and rising inequality. Now let's zoom out across the modern world and look at China, because China today is showing remarkably similar patterns. And before we dive into the specifics, I want to say this. If you're interested in understanding how economic systems work and how to navigate uncertainty, you need to subscribe to this channel right now. We break down complex economic concepts and show you what they mean for your life. So hit that subscribe button and let's continue. Let's start with debt. China's total debt to GDP ratio is now somewhere between 250 and 300%. Some estimates put it even higher. That's enormous. And it's not just government debt. It's corporate debt, household debt, and shadow banking debt, all combined. Now for context, the United States debt to GDP ratio is around 130%. Japan's is around 250%. The United States and Japan have deep, liquid financial markets. They have currencies that are trusted globally. They have diversified economies. China's debt is heavily concentrated in the real estate sector, in state-owned enterprises, and in local government financing vehicles. And much of that debt is based on the assumption that real estate prices will keep going up forever, which, spoiler alert, they won't. In 2023 and 2024, we've seen major cracks in China's real estate market. Developers like Evergrande and Country Garden have defaulted. Home sales have plummeted, and young people are increasingly refusing to buy homes at the inflated prices. This is a massive problem, because real estate accounts for roughly 30% of China's GDP. When that sector contracts, the entire economy contracts with it. And the government can't print its way out of this problem the way Rome tried to do, because that would cause inflation and destroy the value of people's savings.
But the debt problem goes deeper than just real estate. China's local governments have been financing infrastructure projects through special bonds and financing vehicles that are essentially off-balance sheet debt. Some estimates suggest that local government debt could be as high as 40 or 50 trillion yuan. That's roughly $6 to $8 trillion. And much of that debt was used to fund projects that don't generate much economic return. Ghost cities, empty highways, unused airports. These projects looked good on paper. They boosted GDP growth in the short term, but they didn't create sustainable economic value. So now the government is stuck with debt obligations, but without the revenue to pay them off. Now let's talk about productivity, because this is where China's situation gets really concerning. For the past 4 decades, China's economic growth has been driven by 2 main factors: rapid industrialization and massive investment in capital. Factories were built at an unprecedented scale. Highways, railways, and ports were constructed across the country. Workers moved from rural areas to cities, and this created explosive GDP growth. But here's the problem. That model has hit a wall. China's working-age population is now declining. The one-child policy, which was in effect from 1980 to 2015, created a demographic time bomb. There are fewer young people entering the workforce than older people leaving it. This means that labor productivity gains will slow down. Companies can't just hire more workers anymore. They have to become more efficient. But China's economy is still structured around labor-intensive manufacturing. It hasn't successfully transitioned to a high-productivity, innovation-based economy the way South Korea or Japan have.
Moreover, China's capital productivity is falling. That means each unit of investment is generating less economic output than it used to. This is a classic sign of an economy that's becoming saturated. You can only build so many factories and highways before you hit diminishing returns. And China has already built an enormous amount of both. So now, to generate the same amount of GDP growth, the government has to invest more capital. But that capital comes from debt, and the debt is becoming unsustainable. According to data from the International Monetary Fund, China's incremental capital output ratio has been rising steadily. In the 1990s, it took roughly 3 yuan of investment to generate 1 yuan of GDP growth. By 2020, it was taking 6 to 7 yuan of investment to generate the same 1 yuan of growth. It means the returns on investment are declining. It means growth is becoming more expensive to achieve. And it means the debt problem is getting worse, not better. Let's look at the map of China's major cities and industrial centers. If we look at the geographic distribution of China's economy, we can see that growth has been heavily concentrated in coastal regions and major urban centers. But as the economy matures, growth in those areas is slowing down. The government has been trying to develop inland regions through massive infrastructure investments. But those regions still have lower productivity and lower returns on investment. So the overall productivity growth rate continues to decline. Now let's talk about urban decline. This is where the parallel to Rome becomes almost eerie. China has experienced unprecedented urbanization over the past 4 decades. The urban population grew from roughly 20% in 1980 to over 60% today. Hundreds of millions of people moved to cities, and this created enormous economic growth. But starting around 2015 or 2016, something shifted. Property prices in many second and third tier cities stopped rising. In some cases, they started falling. Young people stopped moving to these cities. In fact, some cities started experiencing net outflows of population. You've probably heard about China's ghost cities, Ordos, Kangbashi, Zhengzhou New District. These are massive urban developments with hundreds of thousands of apartments, shopping malls, office buildings, and infrastructure. But they're mostly empty. Why? Because the developers built them based on the assumption that population would keep flowing in and property prices would keep going up. But those assumptions were wrong. So now these cities sit half empty, generating no economic activity, while their local governments are stuck with debt obligations from the construction projects. This is exactly what happened in Rome. As the economy contracted, people left the cities. Urban centers that had been thriving became hollow shells, and the economic consequences were devastating. Because cities are where trade happens, they're where specialized skills develop, they're where ideas spread. When cities decline, the entire economy loses dynamism. In Rome, as cities emptied out, specialized craftspeople lost their markets, merchants lost their trading partners, intellectual and cultural life declined. The knowledge and skills that had made Rome great started disappearing, and once that knowledge is lost, it's incredibly hard to rebuild. The same thing is starting to happen in some of China's cities. Young people are leaving, birth rates are falling, small businesses are closing, and the economic vitality is draining away. Now let's talk about inequality. This is the 4th warning sign, and it's crucial. During China's boom years, inequality actually decreased in some measures, because so many rural people moved to cities and joined the modern economy. But over the past decade, inequality has been rising again. The wealthy have accumulated enormous assets in real estate, stocks, and businesses. Meanwhile, young people are struggling to afford homes, struggling with job prospects, and struggling with the cost of living. A college graduate in a second-tier city might earn 5,000 to 8,000 yuan per month, but a small apartment costs 10 times their monthly salary. This creates social tension, it creates political instability, and it reduces economic dynamism because people have less disposable income to spend on goods and services. When people are struggling just to survive, they're not buying consumer goods, they're not starting businesses, they're not investing in education or skills. The entire economy becomes less dynamic. And here's the counterintuitive part. Rising inequality during economic contraction is actually more destabilizing than rising inequality during economic growth. When the economy is growing, people can tolerate inequality because they believe they have a chance to move up. But when the economy is stagnating and inequality is rising, people feel trapped. They feel like the system is rigged against them, and that's when social unrest becomes a real possibility. So, we've established that China is showing the same 4 warning signs that preceded Rome's collapse: runaway debt, declining productivity, urban decline, and rising inequality. But here's the critical question: does this mean China is heading for collapse? The answer is more nuanced than you might think, because China's situation is different from Rome's in some important ways. First, China has a much more diversified economy than Rome had. Rome was dependent on agriculture and military conquest. China has manufacturing, technology, finance, services, and agriculture. It's much more resilient to shocks in any single sector. Second, China has enormous foreign exchange reserves. China has roughly $3.5 trillion in foreign currency reserves. Rome had no such reserves. This gives China a cushion to work with if things get really difficult. Third, China's government has demonstrated an ability to make difficult economic decisions. It's not a democracy, which means it can implement unpopular policies without worrying about elections. Whether that's good or bad is a separate question, but it does mean the government can act decisively if needed. But here's the catch: all of those advantages come with serious limitations. A diversified economy doesn't help if the entire global economy is slowing down. Foreign exchange reserves can be depleted if a country runs persistent deficits. And the ability to make unpopular decisions doesn't matter if those decisions are wrong. So what should you be watching? Here are the key economic indicators that will tell us whether China is following Rome's path or whether it can break the cycle. First, watch the real estate market. If prices continue to fall and defaults continue to rise, that's a major red flag. The real estate sector is too big to fail in China's economy. If it collapses, the entire financial system could be at risk. Second, watch productivity growth. China's productivity growth has been slowing for years. If it continues to slow or turns negative, that's a sign that the economy is becoming saturated and can't grow its way out of its debt problem. Third, watch population trends in second and third tier cities. If more cities start experiencing population decline, that's a sign that urbanization has peaked and the economic model is shifting. Fourth, watch consumer spending. If Chinese consumers start saving more and spending less because they're worried about the future, that will slow down the economy further and reduce tax revenues. Fifth, watch inequality. If the gap between rich and poor continues to widen, that could create social instability that undermines the government's legitimacy. Now, I want to be clear about something. I'm not predicting that China will collapse. Collapse is an extreme outcome, and it's not the most likely scenario. What's more likely is that China experiences a period of slower growth, higher unemployment, and economic restructuring. That's painful, but it's not collapse. It's what happens when an economy that's been growing at 10% per year has to adjust to growing at 3 or 4% per year. But here's why this matters to you. If China's economy slows down significantly, that has ripple effects across the entire world. China is the world's second largest economy. It's the world's largest exporter. It's a major source of demand for commodities, energy, and raw materials. If China's economy contracts, that affects everyone. It affects your job prospects. It affects your investment portfolio. It affects the prices you pay for goods at the store. So understanding these economic warning signs isn't just an academic exercise. It's practical knowledge that helps you navigate an uncertain economic future. So, here's what I want you to do. Subscribe to this channel because we're going to keep tracking these economic indicators and breaking down what they mean for you.